Good morning, and welcome to Capital Sound. Relief rally, oil slump, and then overnight, oil bounced. If it just fell sharply, why did it rebound? And why does Hormuz still feel like a live wire? I'm Mandy Prince, and with me today is Nova Chen.
Morning, Mandy. Great to be here.
Quick snapshot before we go deeper. Stocks are modestly higher this morning, with risk appetite improving but not roaring. The VIX is sitting in the low teens, suggesting calm but not complacency. Cyclicals are leading while defensives are softer, and yields are edging up slightly. That's the surface. The real question is whether this relief move is durable.
My main thesis is the rally is fragile. The market is celebrating a clean de-escalation that the physical energy tape doesn't confirm, and at the same time rates are front-running cuts the central bank isn't ready to endorse. It's a sugar he, strong in the moment, but it can fade fast if energy and policy reality don't line up.
You just hit two pressure points in one sentence: energy reality and rates reality. Let's start with the energy angle. If oil dropped hard, why do you think the bounce matters?
Because the drop feels like a relief trade rather than a structural shift. When I look at real flows and shipping chatter, I'm not seeing a clean, durable de-escalation. The current limitation is that real-world logistics are still nervous, so the price drop can reverse if the flow signals don't confirm. In past episodes, I've seen this. You get a headline-driven drop, but the physical tape, actual shipment behavior, tells a different story.
Okay, translate physical tape for listeners.
Sure. I mean, what real-world traders and shippers are doing? Are they actually routing cargo as if risk is gone, or are they paying up for protection and taking longer routes? That behavior shows whether the risk premium is truly fading.
Got it. So is this a clean de-escalation, or are we looking at a pricing mirage?
Eileen, mirage. The energy risk is shifting, not disappearing. We may not be looking at missiles, but we could be looking at payment frictions, shipping insurance, or alternative routing. Costs that sneak into the price even when the headline says calm.
You're threading a needle here. Less dramatic headlines, but costs still rising under the hood.
Exactly. And I want to stress the vision but anchor it in reality. The convergence opportunity in energy and payments is real. Digitized tolling, real-time settlement, smarter routing. But the barrier we're watching is enforcement and compliance. Adoption is still limited because infrastructure and sanctions are heavy constraint.
Before we jump to that, the bigger debate: are traders front-running cuts the Fed has explicitly warned against? It feels like the market is shouting cuts are coming while the Fed is clearing its throat.
That's the core tug of war. If the market is pricing faster easing, but the central bank is still holding the stick, you get a credibility gap. The bond market is trading a fairy tale while the Fed is still holding the stick. That mismatch creates snapback risk in yields if energy creeps higher again.
Credibility gap is a mouthful. For people listening on a commute, what does that mean in plain English?
It means traders are betting the central bank will be nicer than it's telling us. If the Fed doesn't follow that script, rates can pop up quickly, and that can push back against stocks.
So under the hood, we've got energy risks morphing, rates markets ahead of the Fed, and a rally on top. It doesn't sound stable.
It's not stable yet. The current limitation is that policy outcomes are uncertain, and energy flows are still fragile. That doesn't kill the rally, but it makes it precarious.
Let's do the clash head on. The market seems to be pricing de-escalation. Are they right?
I would argue they're early. Not necessarily wrong, but early. This reminds me of the 2022 rate shock, when markets were too eager to believe the inflation peak was in. We got multiple false starts. We could see a similar pattern, a burst of relief, then a repricing when reality catches up.
Ooh. And if I push back and say, but oil dropped in a way that eases inflation fear, and Fed officials have been talking more gently lately, what's your response?
That's the strongest case for the market's optimism. A mid-teens oil move does ease inflation anxiety, and some officials are clearly talking about the next move being a cut. I'm not dismissing that, but I'd want to see the physical signals confirm it and the Fed's language align consistently. Otherwise, you get whiplash.
So you're not saying the market is delusional, just premature?
Exactly. And I'll self-check here. My first instinct was this is pure relief trade. Then I looked at the data. The cost curves in energy logistics and digital payments are actually improving, which should reduce friction long term. But in the near term, adoption is still constrained by policy. The barrier we're watching is enforcement. Until that clears, the short-term rally is vulnerable.
That brings us to the curveball. There's a lot of chatter about a payments angle at Hormuz, Bitcoin tolls, settlement constraints, a sort of quiet tax on energy flows. What if the real risk isn't missiles, but payments?
That's the stealth risk. If the tolling concept becomes real, you could reprice energy flows without a single tanker getting hit. The convergence opportunity is that payments tech can compress transaction time and reduce friction. But the current limitation is legitimacy and enforcement. If it's in a gray zone, the cost doesn't go away. It just moves. That can break the assumed correlation between calm geopolitics and lower oil.
Translate that. Correlation break and reprice energy flows.
Sure, people often assume if headlines are calm, oil falls. A correlation break means that doesn't hold. Repricing energy flows simply means the cost of moving oil changes because of how it's paid for or regulated, not just because of supply or demand.
Oh, that's a powerful point, and it's not something retail investors are used to thinking about.
It's not, but it matters because the cost curve for payments is improving. Wright's law suggests that as transaction volume grows, costs can fall predictably. The issue is adoption. If it's tied to geopolitics, adoption can be slow or uneven. So the theoretical cost decline doesn't help much in the short run.
Ooh, I want to make sure we're not losing the thread. Your thesis is that relief is fragile because the physical energy signals and policy signals aren't aligned with the market's optimism.
That's right. And I'd add, the payments choke point is an underappreciated risk. It can add an invisible premium even if the missile risk goes quiet.
But to be fair, what's the best argument that the market is right this time?
The strongest case is that oil's drop reduces near-term inflation risk, and if that persists, the Fed's next move is likely a cut. That would validate the rally. Plus, in technology and innovation, cost declines do compound. If energy logistics and payments converge, costs can compress. The barrier is adoption and enforcement, but if those ease, the optimistic narrative can stick.
You're saying the long-term trajectory is still supportive of innovation, but the near-term path is lumpy.
Exactly. The long-term trajectory is compelling. The near-term limitation is the policy layer.
I want to push on the rates angle again. You mentioned a yield snapback. Without getting too technical, what would cause that snapback?
If energy starts drifting higher again, or if the Fed reiterates that inflation is still a concern, the market has to recalibrate. That typically means yields move modestly higher. It's not a catastrophe, but it's a reminder that the central bank sets the pace.
And for someone not watching rates every day, why should they care?
Because higher yields can weigh on growth valuations. It's not about a single day. It's about the discount rate on future cash flows. If you're owning companies with long duration growth, changes in rates matter a lot.
In plain English, a small move in yields can change how much investors are willing to pay for future growth.
That's it.
Let's pivot to your innovation lens. We're not here just to analyze energy. What do these dynamics mean for technology and innovation investing?
It's a reminder that adoption curves are not smooth. Wright's law suggests cost declines as volume accumulates, but adoption timelines are uncertain. The convergence opportunity in payments, energy logistics, and AI-driven routing is enormous. But the current limitation is regulatory friction. That affects time to scale, which in turn affects how quickly valuations can grow into their promise.
There's also a soft guidance element here. In a market like this, what's the mindset you'd encourage?
This is an environment where patience beats speed. When policy and geopolitics are shifting, the biggest risk isn't being wrong. It's being overexposed to being wrong. I like to reduce the number of decisions and focus on quality trends rather than short-term narratives.
That's practical. And you've seen this pattern before?
Yes, I got burned by this exact setup in 2020, overreacting to relief headlines when the supply chain signals didn't match. That experience taught me to watch the physical indicators and the policy layer, not just the market's mood.
That's a useful scar to share. Let's go back to the payments angle. There's a lot of hype around crypto infrastructure, but you're not a crypto evangelist. How do you keep that grounded?
By keeping the lens on cost curves and adoption constraints. Cost declines compound over time, but adoption needs legitimacy, compliance, and real utility. The barrier we're watching is whether major shipping and insurance firms actually use these rails. Until they do, it's a risk factor, not a revolution.
So it's not inevitable winner, it's potentially powerful if the real world adopts it.
Exactly. No guarantees, just a trajectory and a set of constraints.
Let's do a quick reality check with the audience. It's morning, people are opening their apps, and they're seeing green. They might think, great, risk is off. You're saying, slow down.
I'm saying, make sure the map matches the terrain. A relief rally can be real, but it's not durable if the physical and policy signals don't line up. The current limitation is that we don't have confirmation yet.
Let me push one more time. What would make you change your mind and say, okay, the market's right, this rally has legs?
Two things. First, consistent confirmation in shipping and insurance behavior, if those costs drift lower and routing normalizes. Second, clearer alignment between the Fed's language and market pricing. If the Fed openly signals that cuts are on the table and energy stays calm, I'd be more constructive.
Oh, that's specific. I like it. Now, I want to circle back to your phrase, sugar high. It's vivid. What does the fever breaks moment look like?
It's when reality intrudes. That can be a surprise uptick in energy costs, or a policy statement that contradicts the market's optimism. It doesn't have to be dramatic. A small mismatch can deflate the mood.
Does that mean you expect volatility?
I expect tension. Volatility is one way that shows up, but it could also be a choppy, indecisive tape. The barrier to clarity is the policy and payment layer.
I want to acknowledge something. You're talking about a lot of moving parts, energy, payments, central bank, adoption curves. It can feel overwhelming. How do you keep it simple?
I use a three-part lens: cost curves, adoption constraints, and policy. If all three align, I get more optimistic. If one is out of sync, I get cautious.
That's clean. And it's consistent with your innovation framework.
Yes, the vision is long-term deflationary pressure from innovation. The reality anchor is the pace of adoption and policy friction.
Let's do a short scenario map because this feels like a fork in the road day. Give us two paths.
Sure. Scenario A. If shipping costs and insurance premiums ease over the next few weeks and the Fed signals its next move is a cut, I'd expect the risk-on mood to persist and for growth narratives to regain traction. The signal to watch is normalization in shipping and consistent Fed language. Scenario B. If energy flows remain constrained or payment friction increases and the Fed pushes back on market pricing, you could see a quick repricing in rates and a wobble in equities. The early warning sign would be renewed tension in shipping costs or a hawkish tilt in central bank communication.
Which one do you think is more likely?
I lean toward a choppy version of Scenario B in the near term, with a more constructive path later if constraints ease.
That's a useful framing. Now, before we close, I want to challenge you on the innovation angle one more time. Some listeners might say this is all macro. Why should I care if I'm focused on innovation companies?
Because macro sets the discount rate and the adoption environment. If policy friction is high, adoption slows, and even great companies can underperform. If policy friction eases, the same companies can re-rate quickly. I don't ignore valuation. I treat it as a gating factor. The best innovation stories still have to earn their price.
That's important. You're saying price matters, even for visionary themes.
It does. The opportunity is huge, but timing and price are real.
We're almost done. One takeaway moment. If listeners remember just one thing from today, what should it be?
Relief rallies are real, but durability depends on physical signals and policy alignment. If those don't confirm, patience is the smarter posture.
Ooh, I like that. Simple and memorable. Ooh. Let's close with a watch list. Give me 3 specific things listeners should track to see if this rally sticks.
First, watch for enforcement headlines around payments at Hormuz and any impact on shipping costs. That's the hidden pricing lever. Second, track real-time energy flow signals versus ceasefire compliance. Look for normalization in routing and insurance chatter. Third, compare Fed speak with market-implied cuts to see if credibility tension is widening or narrowing.
That's the roadmap. Nova, before we sign off, give us a final line for the day.
Convergence multiplies opportunity, but only if adoption and policy stop fighting it.
Thanks for listening to Capital Sound. Have a great trading day, and we'll be back this evening with a full recap of how the day played out. Have a steady morning, and goodbye.